Welcome to the data dawning, where the data speaks. We listen. It's time to unlock the numbers and decode the story. All right, let's jump right into this deep dive. You've brought us a fascinating stack of sources today, really quite a mix. We've got everything from the super granular stuff like a Bitcoin liquidation heat map and network data.
Right, the real nitty-gritty.
Exactly. And then zooming out to the big picture macro analysis from Darius Dale, which is always interesting, plus insights on jobs, inflation, tariffs, Fed policy, the whole economic puzzle. We've got takes from experts like Mark Meldrum, David Kelly, John Lear, Mark Lieben.
A lot of different voices there.
Definitely. And then adding another layer, specific technical levels from Vincent DeZiano and market commentary from Yahoo Finance. It's quite the collection.
It really is. It's a rich mix, covers a lot of ground, different angles on the market right now. You've got the very specific crypto stuff, the broad economic picture, and the technical chart perspective. Navigating all these diverse views, that's really key right now.
Absolutely. And that's our mission here, isn't it? To unpack all this material, try to cut through some of the noise, pull out the really important insights, those surprising facts, those sharp nuggets of knowledge, and maybe help make sense of some complex, sometimes even contradictory viewpoints that are out there in these sources.
Yeah, making sense of the contradictions is a big part of it.
Think of this as like your shortcut to being genuinely well-informed on what's happening in the current landscape.
Exactly. We're here to guide you through it, point out what really stands out, why it seems to matter, maybe connect a few dots where we can, and definitely highlight where the experts just plain disagree.
Okay, let's start granular then. Let's look directly at some Bitcoin data. First up, you shared this BTC liquidation heat map. For anyone listening who might not, stare at these things daily, what exactly are we looking at here? And why is it useful?
Right. Okay. So this heat map, it's basically a visual representation of potential pressure points in the Bitcoin market. It pulls together data showing where leveraged positions, people trading with borrowed money across different exchanges, are at risk of getting automatically closed out. Liquidated, that's the term.
Ah, liquidated. So forced closures.
Precisely. It shows us where these pools of liquidity are, where forced selling or even forced buying for short positions could suddenly kick in if the price hits certain levels.
So it's flagging areas where traders using leverage could, get wiped out.
That's the stark way to put it, yeah. And by mapping these liquidation points, you can see price levels where a significant amount of capital is kind of clustered. These zones can act like magnets almost.
Magnets. How so?
Well, if the price starts moving towards a really dense liquidation zone, the triggered closures can cascade. One liquidation triggers another, and that can create this follow-on selling or buying pressure that potentially pulls the price even further in that direction.
Okay, I see.
And it can also show areas where maybe bigger players, the whales, might be looking to get in or out of positions because they know there's enough liquidity there to absorb their large orders without moving the price too much initially.
So it's less about predicting an exact price target and more about spotting these potential zones of increased volatility.
Exactly right. It's forecasting where liquidations might start happening or where price could potentially get drawn towards.
Yeah.
It doesn't guarantee price will hit those levels or how far it'll go if it does, but it shows you where the market structure, specifically these leveraged bets, has built up potential energy, potential pressure.
And the colors, purple to yellow.
Yeah, the colors show the density. It's relative. Purple means lower density of potential liquidations, and it shifts through the spectrum up to yellow, which indicates the most concentrated clusters. Those yellow bands are the ones you really watch.
Okay, looking at the image you send over for today, what's standing out right now? What kind of magnitude are we talking about? And where are those prominent yellow zones clustered?
Right, so the total potential magnitude shown on this particular map is around $182.85 million in liquidations across a specific time frame it measures. And yet looking at the colors, those thick yellow bands, they really pop. They show significant concentration.
And where are they located?
We're seeing prominent zones building up around the $106,000 levels. That density kind of extends upwards through the $108,000 area too. And then you see notable clusters also starting to appear in the $110,000. And maybe even potentially higher, pushing towards $112,000.
Interesting levels.
Yeah, these are the areas where, based on the current open leverage positions, you'd really expect price action to get potentially quite volatile if it gets close.
So when you, the listener, see these concentrated areas, especially those bright yellow ones, sitting up there at like 106K or 110K, what's the main takeaway? What should you be thinking?
The takeaway is that these are likely battlegrounds. If price drops towards $106,000 from above, that yellow zone represents potential support if buyers step in strong. But flip side, it's also a critical trigger point for cascading long liquidations, people betting on price going up if it breaks decisively below.
Handled on the upside.
Conversely, if price pushes up towards $110,000 or $112,000, it's testing areas where concentrated short liquidations could happen. Those getting triggered could fuel the move higher, or that zone could act as heavy resistance if sellers defend it. Basically, it flags levels where you just need to pay really close attention, because volatility is much more likely to pick up there.
It's like seeing the market's internal plumbing almost. Laid bare, that definitely gives insight into those specific pressure points. Okay, so now, stepping back a bit for a broader look at the network's overall health, you also provided data from the Clark Moody Bitcoin dashboard. What are some key metrics from that dashboard giving us a snapshot of the network's current state?
Right, the dashboard gives us a more fundamental view of the Bitcoin network itself, sort of beyond just the immediate price action or the leverage games. Looking at the metrics provided here, okay, we see the current price listed at $108,740 and the total market capitalization at $2.16 trillion. That's just the total value of all Bitcoin at that current price. Pretty straightforward.
Right. And what about metrics speaking to the network's health and security? That seems pretty fundamental.
Absolutely. That's where things like difficulty and hash rate come in. The difficulty is listed at 108.37 million. It's a relative measure. And the hash rate is pegged at 956.9 exahashes per second, EHs.
Exahashes. That sounds like a lot.
It is. The hash rate represents the sheer amount of computational power that's being thrown at securing the network. Validating transactions, mining new blocks. A high and generally increasing hash rate signifies a really robust, secure network. It means it's incredibly expensive, prohibitively so for most, to try and attack it.
And the difficulty number relates to that.
Yeah. Difficulty adjusts automatically based on the hash rate to keep the block production time hovering around that target of 10 minutes per block. It ensures that no matter how much computing power joins or leaves the network, Bitcoin maintains its predictable issuance schedule.
And the dashboard mentioned an adjustment coming up soon.
Yes. The next retargeting, the next difficulty adjustment, is estimated for June 13th, 2025. And the projection is for a change of about -3%. A small decrease like that suggests maybe there was a slight dip in the total mining power online recently, or maybe the hash rate just didn't increase quite as much as the algorithm expected during the last difficulty period. Makes it marginally easier for miners to find blocks for the next little while.
Okay. What about the supply side of things?
The dashboard shows the total supply currently sits at 19.876 million Bitcoin. And crucially, 96.64% of the eventual total supply has already been issued. This really underscores Bitcoin's core property, its fundamental scarcity. There's that hard cap, 21 million coins that will ever exist, and the vast majority are already out there, already mined.
We also see some figures there for the Lightning Network. What's that about?
Right, the Lightning Network. That's built on top of Bitcoin. It's what they call a layer 2 solution. It's designed specifically for faster, cheaper transactions that happen off the main Bitcoin blockchain.
For scaling, basically.
Yeah, exactly, for scaling. The dashboard shows a total capacity of 4,085 BTC, currently locked in public Lightning channels, and around 3,737 total channels publicly visible. These numbers give us a sense, albeit incomplete one since it mostly tracks public data, of the Lightning Network's growth and its capacity to handle lots of small, quick transactions efficiently. It shows progress towards Bitcoin being usable for, everyday payments.
And then there are these economic metrics like stock-to-flow ratios. I know that model gets talked about a lot.
Yeah, it does. The dashboard lists the realized stock-to-flow ratio at 119 and the forward stock-to-flow at 113. Now, stock-to-flow models, they try to value Bitcoin based primarily on its scarcity. They compare the existing stock, the total supply, to the flow of new supply being mined each year.
Kind of like gold or silver.
Yeah, exactly. The comparison is often made to scarce commodities. The core idea is that as the flow of new supply decreases relative to the large existing stock, especially after something like the halving event, which cut the new supply rate in half, it should, in theory, support higher prices over the long term. That's the model's premise.
Makes sense. Finally, the nodes. It shows a number for reachable nodes. Why is that important?
Super important for decentralization. The dashboard shows 22,035 reachable Bitcoin nodes with a pretty high percentage, 65.28%, being Tor nodes for added privacy. Each one of these full nodes independently verifies every transaction and every block according to the network's rules. They don't rely on any central authority.
So more nodes equals more decentralization.
Pretty much. A high geographically distributed node count makes the entire network much more resilient, much harder to censor, and truly decentralized. It's fundamental to Bitcoin's value proposition. The Tor node percentage just adds another layer, making it harder to know where these nodes are physically located.
Really high hash rate showing security, the fixed and mostly issued supply emphasizing scarcity, the growing Lightning Network capacity for scaling, those stock-to-flow metrics pointing to long-term value based on that scarcity, and the high node count ensuring decentralization. What's the overall picture of the Bitcoin network that emerges from this data?
Well, the data paints a picture of a network that looks fundamentally secure, it looks resilient, it's clearly making strides in its ability to scale using layer 2 solutions like Lightning, and it's operating exactly as designed with its core scarcity mechanism fully intact. So, regardless of the day-to-day or even month-to-month market volatility, the underlying infrastructure, judging by these specific metrics, appears quite healthy and decentralized.
That gives us a really solid baseline on the asset itself and its technical backbone. That's super useful context. Maybe now is a good time to remind folks, drop a like and share if you find this valuable, because now we're going to shift gears pretty dramatically and look at the broader macro landscape, specifically through the lens of Darius Dale and 42 Macro.
Yeah, let's zoom out and explore their framework. It's quite different.
So in today's Macro Minute segment, Darius Dale brings this very systematic, very data-driven approach to understanding market cycles. Can you tell us a bit about 42 Macro and their core process? How do they figure things out?
Sure. Darius Dale and his firm, 42 Macro, they operate based on something they call their global macro risk matrix. What this involves is analyzing signals from, get this, 32 different global markets.
42.
Wow. Yeah, 42. Including major stock indices, government bond yields from different countries, key currency pairs, important commodities. It's comprehensive. Their whole process isn't about, predicting the future based on their personal opinions or forecasts. It's about interpreting what the markets themselves, these 42 signals collectively, are saying about the current economic regime we're in.
And they categorize these regimes.
Yes, they identify one of four possible regimes based on the data. Goldilocks, reflation, inflation, or deflation. Each has different implications for asset allocation.
And the goal is simply to be positioned correctly for whichever regime the data is pointing to at the time.
That's exactly it. They really emphasize understanding the full distribution of profit economic outcomes, as they put it, making sure portfolios are aligned with the prevailing environment signaled by the matrix. Dale is actually quite humble about it. He states very clearly that the collective intelligence embedded in those 42 markets knows far, far more than he or any single individual possibly could.
So their job is just to listen to the markets.
Pretty much. Their job is simply to notice what the market is pricing in, react to that signal, and position accordingly. Investing, in his view, should be systematic. It should be dispassionate. You got to remove the emotion from the process as much as possible.
Okay, makes sense. So what is the current signal coming from their matrix right now? Which regime are we in according to their data?
The current signal, according to 42 Macro, is Goldilocks.
Goldilocks. Okay, what does that mean in their framework?
In their context, Goldilocks signifies a generally risk-on environment, meaning favorable for assets like stocks, but characterized by a disinflationary bias. So growth is okay, maybe not booming, but inflation pressures are seen as easing or remaining contained. And again, this isn't just like a gut feeling. It's the objective output of their model based on how those 42 markets are behaving together compared to historical patterns.
Okay, so the systematic data points to Goldilocks, which sounds pretty positive for markets, generally speaking. But you mentioned earlier how psychology plays a role. What is Dale seeing in terms of investor sentiment right now, and how does that square with this Goldilocks signal? Because that sounds like a potential conflict.
Yeah, this is where it gets really, really interesting, and it highlights a potential divergence, maybe even a big opportunity, depending on how you see it. Despite their model signaling Goldilocks, Dale points to extremely high levels of economic anxiety and policy uncertainty currently felt among investors.
Really, even with a Goldilocks signal.
Yes. He cites the Baker-Bloom-Davis Index, which specifically measures this kind of uncertainty. He notes it's currently as high as it was during the peak uncertainty of the COVID crash and even the global financial crisis.
Wow, that's incredibly high anxiety. What's driving it, in his view?
He specifically attributes a large part of this current anxiety to the constant noise and uncertainty surrounding tariffs. Just the endless talk, the threats, the potential impacts, it's creating a lot of nervousness.
Okay, so the market's underlying signal, according to their model, is positive, Goldilocks. But Investor sentiment is actually highly anxious, maybe even fearful, driven by things like tariff talk.
That's the core tension he's identifying right now. And he actually believes this high level of anxiety is, in his words, overdone. He thinks the market is perhaps stronger than the sentiment reflects.
And what usually happens when investors are super anxious, maybe sitting on the sidelines, but the market keeps grinding higher or stays resilient?
Ah, well, that's where the psychology kicks in hard. Intense FOMO, the fear of missing out. He sees this widespread anxiety building among investors who are maybe currently underinvested or very cautiously positioned. They're watching, they're nervous, but they also see prices not collapsing.
And his expectation is that eventually this anxiety will crack.
Yes, that's exactly his thesis. He expects this pervasive anxiety will likely lead to what he calls a capitulation to the upside sometime over the coming quarters. He specifically mentioned looking out over the next 12 months,
Capitulation to the upside, meaning
meaning that sidelined, anxious capital will eventually succumb to that FOMO pressure. They'll feel compelled, almost forced, to chase the market higher, potentially pushing prices up even more significantly as they all try to get in.
so given that expectation, what's the actionable strategy based on his analysis?
The strategy that flows from that is to position now, according to the Goldilocks signal their data is showing, before that expected wave of anxious buying hits the market. As he puts it quite vividly, you want to be in line in front of them.
Get positioned before the herd arrives.
Essentially, yes. The idea is to be strategically invested based on the data-driven regime signal before the mass of anxious money feels forced to jump in and potentially drives prices up further, maybe at less attractive levels.
And looking further out, does he see this Goldilocks regime lasting, say, indefinitely, or is it likely to shift?
He suggests, based on what he calls their paradigm C basis, that this Goldilocks regime could credibly last, potentially, until next summer, so maybe another year or so. However, and this is key to their systematic approach, he's careful to acknowledge the possibility of temporary shifts along the way. He mentioned things like a transitory risk-off inflation market regime or transitory risk deflation market regime potentially popping up.
So bumps in the road are possible.
Absolutely. The crucial point for their approach isn't about predicting the future with perfect certainty. It's about being prepared to adjust the portfolio strategy if and when the signal from their 42 market matrix changes. It's about reacting to the data, not sticking to a forecast.
This whole framework really seems designed to cut through that emotional noise. We all feel the FOMO, the fear of losses, and just focus on what the broader market data is signaling about how to be positioned.
That's precisely the goal. By relying on that collective signal from dozens of markets, they aim to remove, or at least minimize, the emotional biases that so often lead investors to, buy high near the peak out of FOMO or sell low near the bottom out of fear. The objective is to, as he says, compound returns from a higher net asset value than the other people who are suffering the drawdown and suffering through the volatility drag. It's all about disciplined positioning based on identifying the current market regime.
That's a really powerful framework for trying to navigate all this uncertainty. Definitely something to think about. And hey, speaking of updates, follow us on Twitter at Snippet Labs for more insights as these macro dynamics continue to unfold. Okay, now let's broaden our view even further. Let's dive into our market spotlight segment, because this is where things get really interesting. When you start looking across different sources, different experts, you see just how many different and sometimes really contradictory interpretations exist about the same economic picture.
Yeah, this is where the neat narrative starts to fray a bit, but it's also where you get incredibly valuable insights, I think. The same headline number, the same economic environment can lead different analysts down completely different paths. We'll just present these views factually, highlighting the data points they use and the differing conclusions they reach.
Okay, let's kick it off with the consumer. We've got some insights here from Yahoo Finance, specifically referencing data from VantageScore. What did their recent findings tell us about consumer health and credit trends? Are people borrowing more or less?
Well, according to VantageScore's data, consumers actually became net borrowers back in April. That means overall they increased their credit utilization. It was a noticeable shift.
Okay, net borrowers. What was driving that increase? Was it credit cards, mortgages, something else?
The report highlighted one area in particular, a significant surge in auto loans. And this wasn't just a small uptick. The increase in auto loans apparently exceeded pre-pandemic highs and showed growth rates they hadn't seen since way back in January 2020.
Wow, a surge in auto loans. Why now?
The reason cited directly in the commentary was that consumers seem to be trying to, quote, get ahead of that tariff pricing that they expect later in the year. Essentially, the fear of future price hikes on cars due to tariffs is apparently motivating some people to make that big purchase now before prices potentially go up.
Huh. So policy fears, tariff talk, directly influencing big-ticket consumer spending decisions right now. That's fascinating. Were there any signs of resilience alongside this increased borrowing, or is it all looking a bit stretched?
No, there were some counterpoints, some signs of resilience mentioned. Even with that higher utilization, average credit balances reportedly remained relatively stable overall. And delinquencies, while they did see a year-over-year increase, were still described as moderate and, importantly, historically resilient compared to downturns.
Okay, so not flashing bright red signals everywhere yet.
Not according to this data.
Why?
Plus, they noted an increase in the percentage of consumers in the super prime credit score segment. That's a score over 780. So continued strength among the highest quality borrowers.
What about the impact of student loan payments restarting? That was a big concern for a while. Did the data show anything there?
Yeah, they touched on that. The resumption of student loan payments did initially put some pressure on delinquency rates, and it caused a slight dip in the average Vantage score across the board. However, the report noted a rebound pretty quickly as consumers adjusted their budgets. The average score apparently returned to 702 and is held around there, which suggests that, on average, consumers demonstrated some ability to manage this new payment burden.
So how does the Fed keeping interest rates high fit into this picture, according to Vantage Score?
Their take seems to be that the Fed holding rates relatively elevated is generally working to limit new credit growth, especially for things like mortgages, and it's also discouraging consumers from maxing out credit cards. So it's generally keeping overall credit utilization lower, except in specific cases like that auto loan surge, which seems driven more by those forward-looking tariff fears rather than easy credit access.
And the key risk they flagged.
The key risk highlighted was what happens if credit utilization continues to climb, maybe driven by more preemptive buying or cost pressures, at the same time that the employment picture starts to genuinely weaken. That combination, rising debt burdens and falling income job security, that would be the concerning scenario.
Which brings us perfectly to the jobs data, because this seems to be a major point of contention and differing interpretations in the sources you gathered. Mark Meldrum, in particular, offers a really critical look beneath the surface of that latest jobs report, the one that seemed to spark a big market rally on Friday.
Oh, absolutely. Meldrum goes deep, and he fundamentally challenges the market's positive knee-jerk reaction to that headline number, the 139,000 jobs supposedly added. He argues pretty forcefully that when you actually peel back the layers of the data and apply proper statistical rigor, the picture looks far weaker, potentially even negative.
Okay, break that down for us. What was his analysis of the household survey data? That's one of the two main surveys, right?
All right, there are two surveys. He points to some really concerning numbers from the household survey. Between April and May, the labor force actually decreased by 625,000 people. The participation rate dropped 0.2%. And the number of employed persons reportedly decreased by 700,000.
Wait, decreased? The headline said jobs were added.
Exactly. Now, the household survey has a larger statistical margin of error than the establishment survey, which gives the headline number. But Meldrum applies that standard error, calculates the confidence interval, and states that with 90% confidence, the household survey data actually shows jobs were lost in that period, not gained. Lost.
Wow. Okay, so one official government survey, when analyzed statistically, points towards job losses, while the headline number the market reacted to showed gains. That is a massive discrepancy right there. It's huge. He also points out the employment-to-population ratio fell to 59.7%, a level we haven't seen since early 2020, during the initial COVID shock. He highlights that the losses were seen across both full-time and part-time roles and across all age groups, and jobs for those with bachelor's degrees or higher. Flat since March. His assessment is pretty blunt. None of this is good.
Okay, so that's the household survey perspective. What about the establishment survey? That's the one that gives us that headline payroll number that everyone focuses on. Does he find issues there too?
He critiques that one as well, but differently. He looks at something called the diffusion index, which measures how widespread job growth is across different industries. For total private industries, that index was exactly 50.
50%? What does that mean?
It means job gains and job losses were precisely balanced across industries. Essentially zero net growth in terms of breadth. For the manufacturing sector specifically, the diffusion index was, in his words, wickedly low at 41.7, clearly indicating contraction or shrinkage in manufacturing jobs. And the revisions. I heard there were revisions to past month's numbers.
Yes, and this is crucial to his argument. He points out significant downward revisions to the numbers reported for the previous 2 months. March's gain was revised down from 185,000 to just 120,000. April was also revised down significantly. He poses the question, if March's number had originally been reported as only 120K, would the market have rallied the way it did back then? Probably not.
Good point. It changes the narrative arc.
It does. And he strongly emphasizes that these numbers are estimates from sample surveys, and they all have standard errors, margins of error. He shows how, if you apply a reasonable standard error, the confidence intervals around those revised numbers for March, 120K, and April, around 147K after revision, and even for the latest May print of 139K. Those confidence intervals either clearly contain zero or, for May, almost contain zero, meaning, statistically speaking, based purely on that establishment survey output and its inherent margin of error, you cannot confidently say that jobs were actually created. It's statistically ambiguous. And that ambiguity stands in stark contrast to the statistically confident signal of job losses coming from the household survey.
He also brings in a third piece of data, right? The Challenger job cut report.
Right, that's an objective measure of announced corporate layoffs. The Challenger report showed nearly 99,000 job cuts announced in May. That's up 47% compared to May of last year.
Up 47% year over year. That sounds significant.
It is. And year to date, through the first 5 months of the year, announced cuts are already at 700,000. That's an 80% increase from the same period last year, and it's already getting close to the total number of cuts announced in all of 2024, which was around 765,000. He also notes these cuts are coming from wide areas. They're not just concentrated in one troubled sector like tech anymore. And meanwhile, announcements of new job creation plans are apparently at historic lows.
Okay, so let's put Mildrum's case together. You've got the household survey statistically pointing to job losses. You've got the establishment survey being statistically ambiguous about gains, especially after major downward revisions. And you have objective data showing layoff announcements surging and hiring plans dwindling. What's his overall conclusion about the state of the job market based on all this?
His conclusion, based on this multifaceted statistical analysis, the revisions, the diffusion index, and the Challenger data, is that the U.S. economy appears stagnant or flat on job creation, statistically speaking. Therefore, he believes the market's party on Friday, the big rally after the headline print, made no sense and was fundamentally a mistake, especially when you also consider the recent, relatively benign inflation readings we've had.
Wow, that's a strong counter-narrative. Does anyone else echo this view that the labor market might be slowing down more than the headline number suggests?
Yes, actually. David Kelly, who's the chief global strategist over at J.P. Morgan Asset Management, he broadly agrees with the assessment of a slowing labor market beneath the surface. He talks about seeing a broad slowdown in overall economic activity, even though markets have been strong.
And what specific labor market signs does he point to?
He explicitly cites those downward revisions to payrolls that Meldrum highlighted, noting the average monthly gain from January to May was only 124,000 after revisions. He also mentions the falling participation rate and the rising layoff announcements as clear evidence that the labor market is slowing down.
Does he connect those layoffs to the uncertainty factor we discussed earlier?
He does. He confirms that the Challenger data showing elevated layoffs, that 47% year-over-year jump, looks a little bit more sinister than just normal economic churn. He attributes it directly to companies being frozen by the uncertainty surrounding things like tariffs, the future path of the economy, potential tax policy changes, you name it. This uncertainty, he says, is causing widespread hesitation on hiring.
So that uncertainty has real consequences for jobs.
According to Kelly, yes. While this hesitation might be helping to keep wage inflation pressures down, something he's not too worried about long term, he sees it as definitely problematic for overall economic growth right now.
Okay, so here we have a really clear, stark contradiction presented right there in the source material. The market reacts strongly positive, rallies hard on a single headline number, 139K jobs, but multiple experts digging into the statistical details, the survey methodologies, the significant downward revisions, and the objective layoff data conclude that the job picture is statistically ambiguous at best, maybe stagnant, and potentially even showing significant underlying weakness.
It really highlights how markets can sometimes, react very simplistically to a single data print, perhaps ignoring or not fully absorbing the underlying complexities, the nuances, and the varying expert interpretations that paint a much more complicated picture.
Yeah. Definitely something to keep in mind. Let's remind everyone again, drop a like and share if you're finding this dissection valuable. Okay, let's pivot slightly and talk about inflation, because that ties directly into this jobs data debate and, of course, what the Federal Reserve might do next. And just like with jobs, there seem to be different views on the path of inflation, especially when it comes to the potential impact of tariffs.
Yeah, inflation's another area with significant divergence. You saw the bond market reaction on Friday, right? Yields went up.
Big.
That seemed to align with the view that perceived job strength, even if potentially misinterpreted, removes the possibility of near-term Fed rate cuts. The fear is that a strong job market means inflation will stay sticky, so the Fed can't cut.
Right, the market priced out cuts.
Hmm.
But Meldrum's perspective on inflation, combined with his view on jobs, leads him to the opposite conclusion about Fed policy, doesn't it? He thinks they should be cutting now.
He absolutely does. Meldrum argues that the actual inflation data we've gotten over the last 2 months, looking at both CPI, Consumer Price Index, and PCE, Personal Consumption Expenditures Price Index, has been, in his word, benign. He points out that if you annualize some of those recent monthly figures, they're actually running below the Fed's 2% target already.
Below target.
Yeah, on some measures, yes, based on the recent monthly prints annualized. So based on this benign inflation data, plus his view that the job data is actually weak beneath the surface, he believes the Fed currently has permission from the data to cut rates now. He feels they should be cutting by 25 or even 50 basis points immediately to be forward-looking and get ahead of potential deflationary pressures he sees building, partly from AI too.
Okay, so he sees the current inflation data as supportive of cuts, even with all the tariff talk swirling around. What do other experts say specifically about how those tariffs might impact inflation? Is it an immediate threat or more down the road?
Well, John Lear, who's the chief economist at Morning Consult, he expects the upcoming CPI report this week will probably remain stubbornly high, maybe reflecting some pass-through effects already in the pipeline. However, he believes the full impact of the newly announced or threatened tariffs is not yet visible in the data.
Not yet seen, so when does he expect it?
He predicts more of a steady drip of price increases that spreads out gradually, maybe over approximately 2 years. He thinks this slower pace is likely due to competitive dynamics. Companies might hesitate to be the first to raise prices significantly, and also companies wanting to see more stable, predictable policy before fully passing on those higher costs. So he thinks the tariff impact in the May CPI report, the one coming out Wednesday, will likely be muted.
Okay, so Lear sees a slow, gradual, multi-year impact from tariffs. What about David Kelly at JP Morgan? Does he agree with that timeline?
David Kelly seems to have a different view on the timing and magnitude, at least based on the summary. He's predicting higher inflation by the end of this year, specifically forecasting the consumption deflator, a key inflation measure for the Fed, reaching 3% to 3.5%. And he attributes this expected increase directly to the tariffs, mentioning both the potential 10% universal tariff and the specific 30% tariff on Chinese goods that have been discussed.
3.5% by year end due to tariffs. That sounds like a much faster and more direct inflation impact than Lear's 2-year gradual drip assessment.
It certainly seems like a more front-loaded impact in Kelly's view. So here again, you have experts disagreeing quite significantly on when and how much these tariffs are likely to impact inflation. Is it muted and gradual over years at Lear, or is it a more significant driver pushing inflation higher by the end of this year? Kelly.
And that disagreement feeds directly into the debate about Fed policy, right? Should the Fed cut now, based on the recent benign data, as Meldrum argues, or should they hold steady, perhaps anticipating that future tariff-fueled inflation is coming down the pike, which seems to be Kelly's outlook and maybe what the bond market was reacting to?
Exactly. It highlights just how complex this specific piece of the economic puzzle is right now. There's no consensus on the inflation outlook, particularly concerning tariffs. That's why the upcoming data releases CPI on Wednesday and then PPI, Producer Price Index, on Thursday are going to be watched extremely closely. They might provide more clarity or maybe just add more fuel to the debate.
Absolutely critical data points this week, then. Let's connect this directly to Fed policy expectations. How is the market pricing things now after Friday's jobs report and bond market reaction?
Well, the market, as you can see in the Fed funds futures pricing, is anticipating very, very few rate cuts in the near future. Traders are pricing in almost no chance, like 97.4% probability against the cut at the upcoming June Fed meeting. Looking further out, they're pricing in less than one full 25 basis point cut by the end of the third quarter, and only about 2.5 cuts total priced in by the first quarter of 2026.
So basically, the market saying higher for longer is still the base case.
That's what the pricing implies. The bond market sell-off on Friday seemed to really cement that view. The interpretation was that the jobs data, rightly or wrongly interpreted, prevents the Fed from cutting soon because inflation concerns will linger.
But Meldrum, as we discussed, thinks that this market pricing is fundamentally wrong. He's actively betting against it.
He is, quite strongly. Based on his analysis, the underlying job weakness, the benign inflation prints recently, and his view on potential deflationary risks down the road, including from AI, he believes the market is making a big mistake by pricing in virtually no immediate cuts.
And he thinks the Fed should cut now.
Yes, he argues the Fed should be cutting 25 to 50 basis points now to be appropriately forward-looking and manage risks. He believes the market's current stance, this reluctance to price in cuts, will eventually force the Fed into playing catch-up later, potentially with larger cuts down the line if the economy weakens more than expected. He also points out, importantly, that the recent rise in longer-term bond yields is already making monetary policy more restrictive, even without the Fed actually hiking the short-term Fed funds rate.
So the market is doing some tightening for the Fed already.
In effect, yes. And Meldrum is putting his money where his mouth is. We mentioned being long Fed funds futures, which is a bet that the market is wrong and rates will actually come down sooner or faster than currently priced.
That's fascinating. To see such strong conviction betting directly against the prevailing market sentiment, all rooted in a fundamentally different interpretation of the same underlying data. Now, Jared Blicker over at Yahoo Finance had an interesting piece, sort of a scoreboard on what typically moves markets most. Is it jobs data, CPI data, or the Fed itself? What did his analysis show?
Yeah, that was interesting. Blicker looked back at market reactions since the bull market arguably began in October 2022. His scoreboard showed that, historically over that period, CPI days have actually been the biggest positive driver for the S&P 500. They added significantly more cumulative percentage points to the index compared to jobs data days, and they managed to overcome the negative drag typically seen on Fed decision days.
So inflation news has been the key driver for stocks.
Historically in this bull run, yes. However, he notes a potential shift happening since last November. More recently, jobs data days have actually become a negative for stocks, maybe reflecting those good news is bad news dynamics regarding Fed policy. CPI days have become more volatile and kind of flat in their impact lately, and Fed decision days remain a net drag on stocks.
What about bond yields? What drives those?
For bond yields, specifically the 10-year Treasury yield, Blicker's analysis showed that Fed days historically tended to push yields lower. But again, since last November, jobs data has emerged as the significant driver, consistently pushing yields higher, signaling those inflation worries tied to the labor market. Friday's jobs report driving the 10-year yield up 10 basis points was a perfect recent example of that dynamic.
So his takeaway is?
His synthesis is, jobs data seems to be setting the tone for bond yields, reflecting inflation Fed expectations. Inflation data historically steered stocks, though maybe less so recently. But ultimately, he concludes, the Fed makes the rules. Their decisions and communication are paramount.
Right. So we see the tension again. Market pricing says no cuts soon because of inflation fears possibly stoked by jobs data. Meldrum argues the Fed should cut now based on benign inflation and weak underlying jobs. Blicker shows how different data points have historically moved markets, but with some recent shifts in those correlations. And then other commentators add nuance about the Fed's potential motivations beyond just the data.
Exactly. It's a complex interplay.
Speaking of the Fed's motivations, Mark Leneman at Citizens JMP had a pretty direct view on whether the Fed should feel any pressure, perhaps political pressure, to cut rates. What was his take?
Leneman was very straightforward. He stated firmly that the Fed should not capitulate to any political pressure from the White House or anywhere else regarding rate cuts. He emphasized that their clear mandate is fighting inflation, and in his opinion, they are currently doing a good job fulfilling that specific mandate. Full stop.
So focus on the mandate, ignore the noise.
That was his message.
And David Kelly added another potential factor that might be contributing to the Fed's hesitation to cut, didn't he? Something beyond just the economic data.
Yes, David Kelly suggested that part of the Fed's reluctance to cut rates right now might not just be about the economic data or hitting the inflation target perfectly. He speculated it could also stem from a hesitation to further fuel what he views as already very high equity valuations.
The asset bubble concern.
Potentially, yes. He suggested that cutting rates could potentially push already elevated stock prices even higher, which is something the Fed might view with considerable caution, maybe even concern.
Okay, so the Fed's decision-making process is seen through multiple lenses here. Their official inflation mandate, Lana Raman, differing interpretations of the economic data, Meldrum versus market, potential concerns about asset valuations, Kelly, and undoubtedly the background noise of political dynamics. It's complicated. Hey, if you want more expert takes on these complex Fed issues and market reactions, make sure you subscribe to the Snippet Labs YouTube channel. All right, let's talk about another massive factor looming over the future landscape. Artificial intelligence, AI. There seem to be quite different views in your sources about its immediate and long-term impact, especially on jobs.
Yes, AI definitely emerged as a significant topic, and perspectives varied quite a bit. Mark Meldrum, for instance, takes a very strong stance. He views AI as fundamentally deflationary in its potential impact, and he believes it is ready today to eliminate most entry-level jobs, specifically those operating in what he calls lower cognitive domains.
Ready today, that's a bold claim.
It is. He explicitly dismisses optimistic narratives that focus solely on AI creating new jobs as irresponsible. He points to anecdotal evidence of companies already using AI implementation as a justification for layoffs. He argues forcefully that the entire history of major technological change supports his view. New technologies disrupt and eliminate existing jobs, often painfully and significantly, before new, unforeseen types of jobs eventually emerge much later.
So his core view is about immediate, potentially large-scale job displacement.
That seems to be his primary concern, yes. And the practical advice that flows from this deep uncertainty is quite stark. He says, essentially, due to AI's potential pace and disruptive power, you cannot have a 5-year plan, you can only have a today plan. You need to be adaptable day to day. He also mentioned using AI models himself, like Manus, but strongly emphasized the absolute necessity of rigorous human critical thinking. First, you have to guide the AI properly and critically evaluate its output, not just take it at face value.
Okay, that's a pretty sobering perspective. How do other experts in your sources view AI's impact on jobs and the economy? Is everyone that pessimistic?
Not necessarily with the same immediacy or severity, but the impact is widely acknowledged. David Kelly, for example, connects AI back to the current uncertainty factor. He acknowledges that the layoff announcements we're seeing are real, and that corporate uncertainty, including fears and unknowns about AI's role, is a contributing factor to companies hesitating on hiring right now.
So AI fear is part of that frozen by uncertainty dynamic he mentioned.
It seems to be part of the mix, yes. Interestingly, while he sees AI potentially impacting the labor supply, he doesn't seem overly worried about AI causing long-term wage inflation issues, perhaps because of its potential to displace workers or increase productivity. His bigger concern related to AI uncertainty seems to be its negative impact on overall economic growth due to that hiring hesitation. Then you have John Lear from Morning Consult. He definitely sees AI as a major structural change coming, but he anticipates more of a gradual but protracted period of change rather than an immediate sharp step function downwards in employment.
So more evolutionary than revolutionary in the short term, at least.
That seems to be his take. He focuses more on AI's role in increasing efficiency, particularly for white-collar jobs. He believes we are still in the early stages of this transformation, estimating that widespread implementation and execution of AI strategies are likely still 2 years plus out for many companies.
Okay, so Lear sees a much slower, longer-term transition compared to Meldrum's view that AI is ready today to eliminate many jobs. That's quite a difference in timelines.
It is. And Mark Lemon adds another angle. He highlights that AI monetization companies actually figuring out how to make money from AI, not just use it internally, is a really important catalyst for the economy that isn't yet fully captured in the national economic data. He acknowledges that DeepSeek concerns these worries about the rapid, unpredictable, almost runaway nature of AI advancements definitely exist out there. But he also notes that private investment in AI companies remains incredibly strong, which signals a continued powerful belief in its long-term potential and profitability.
Okay, so synthesizing these diverse views on AI, there seems to be broad agreement that it's transformative, it will impact jobs, it will increase efficiency, particularly affecting entry-level or lower cognitive roles initially. But the key disagreements lie in the pace. Is it happening right now, as Meldrum fears, or is it more gradual over the next 2+ years, as Lear suggests? The primary immediate outcome, is it mainly job elimination, or is it efficiency gains and a new economic catalyst via monetization? And the overall certainty and predictability of its path.
Exactly. And Meldrum's advice to only have a today plan kind of emerges as a pragmatic, if maybe slightly unsettling, response to living within that wide spectrum of uncertainty about AI's future impact.
It certainly reflects the challenge of long-term planning when facing such a potentially massive technological shift. Okay, let's bring in the final major source of uncertainty that was highlighted across the sources: tariffs trade policy, and the related political dynamics swirling around them.
Yeah, this has been a really persistent factor contributing to both market volatility and that economic anxiety Dale talked about. Yeah. Your sources specifically noted a development on this front. A meeting scheduled in London for June 9th. It involved high-level U.S. officials from Treasury, Commerce, and the USPR, the U.S. Trade Representative, meeting with Chinese representatives specifically to discuss trade issues.
A high-level U.S.-China trade meeting. How did former President Trump comment on this meeting, according to the sources?
Well, apparently, via his Truth Social platform, Trump announced he was pleased about the meeting taking place, even stating it should go very well. He suggested it might provide an opportunity for negotiators to potentially consider lifting certain U.S. export controls on China. However, he also reportedly added a caveat that China would have its own demands, including requiring very public levels of respect. This really underscores the intense political sensitivities and face-saving aspects involved in these negotiations, beyond just the economics.
How did other experts interpret this meeting or the broader trade picture?
David Kelly expressed hope that maybe this meeting signaled a potential move towards more reasonableness and a desire to maintain trade flows, suggesting that perhaps the April period represented the high water mark for the really intense tariff-related noise and threats. Mark Lippin also seemed somewhat optimistic, suggesting the really draconian noise on tariffs might potentially be in the rearview mirror, and noting that the market generally likes the prospect of dialogue and trade talks happening.
The sources also touched on how Trump's other public commentary, and even some personal dynamics involving him, factored into market analysis or speculation.
Yes, they did. Meldrum, for instance, specifically highlighted Trump's ongoing, consistent commentary via Truth Social, pushing his views on the Fed needing to cut rates much more aggressively, commenting on the economy's performance, claiming it's great, and reiterating his stance on tariffs.
And the feud with Elon Musk?
Right, that came up too. The public feud between Trump and Elon Musk was discussed, with Meldrum apparently speculating on the timing of certain events like suspicions around a potentially fake tweet calling Musk mediocre, followed by leaks about Musk's alleged drug use. Meldrum reportedly suggested these might be connected to perceived disrespect or disloyalty from Musk towards Trump.
And Meldrum's takeaway from that feud?
His view was apparently quite stark, that this public feud would likely have very serious consequences for Elon Musk personally, and perhaps his companies. He stated Trump seems to have no desire to repair his relationship and holds a belief that a price must be exacted for perceived disloyalty or disrespect. Mark Lehman also acknowledged this ongoing dynamic between Trump and Musk as a factor that investors are aware of and considering in the background.
So how does all this policy uncertainty, the tariff threats, the trade negotiations, the political backdrop, even these personal feuds involving major figures, how does it connect back to the broader market picture we've been discussing?
Well, as David Kelly explicitly noted, this kind of policy uncertainty is seen as a major reason why companies are feeling frozen and hesitating to hire, which directly impacts the jobs picture we discussed. Darius Dale pointed to tariff talks specifically as a key driver fueling that extremely high economic anxiety index he tracks. And Mark Meldrum even observed that Friday's afternoon market rally seemed to coincide with the news breaking about that London U.S.-China trade meeting, suggesting that specific news flow around these sensitive political and trade issues can have an immediate, tangible impact on market sentiment and movement.
It's abundantly clear, then, that navigating today's market requires understanding not just the economic data prints, but also how these layers of policy fears, the potential disruption from technology like AI, and these complex political dynamics are all interacting to create uncertainty and influence how different experts are interpreting the landscape.
Absolutely. It's a multi-dimensional puzzle right now. Okay, so let's shift gears one last time and move to a completely different kind of analysis, the purely technical perspective on market indices and specific stocks. We're focusing here on key price levels, chart structures, support, resistance. And the guiding principle here, as trader Vincent DeCiano often puts it, is trade what you see, not what you think.
Right. This means setting aside the macro views, the fundamental opinions, the news flow, and just focusing intently on the price action itself, the charts, and those specific levels where buyers and sellers have shown up before. So what are the key technical observations for the major market indices right now, according to DeCiano's analysis?
Okay, starting with NASDAQ Q futures in Q. DeCiano notes that as of his analysis, they were trading right smack in the 50% range of Friday's entire price move. What that means, practically, is there's no immediate clear directional edge for short-term intraday trading. It's just chopping in the middle.
So what levels are important to watch them?
He highlights key downside levels. Friday's low which was around 207.22. Below that, there's a potential gap fill area around 216.35. Then a significant previous high that could now act as support sits around 21.560. And potential targets could extend further down towards the daily 20 simple moving average, SMA, or maybe the around 21,300 level if selling pressure really picks up.
And on the upside, where's the resistance?
Key upside supply, or resistance zones, are Friday's high at 21.70 and then a notable zone between 20,1900 and 219.35. He pointed out how prices failed around that 21,870 level previously, leading to some sharp drops, even noting a pattern that looked a bit like an intraday head and shoulders formation. So the overall message for NASDQ futures was caution until price clearly breaks out of Friday's range, either above the highs or below the lows.
Okay, what about the S&P 500? How does its technical picture look?
The S&P 500 futures contract, ES, was described as having somewhat messier, trappier price action recently compared to the NASDQ. This makes getting a clean read much more difficult than usual in his view.
Messier and trappier. Not ideal for trading.
Not ideal, no. He identifies 6025 on the upside as a cautionary level and a major high to watch. On the downside, he notes a potential low-volume gap between Friday's lows, which were around 6,008, and an area of demand down at 5,973. That 5,973 level is seen as a possible downside target if the lows break. But he acknowledged the difficulty in predicting exactly how the market will react around these key levels, like the round 6,000 number, that 6,025 high, or the 5,973 support, given the choppy conditions.
But he mentioned the STY ETF chart looked a bit cleaner.
Yes, interestingly, he pointed out that the chart of the SPY ETF, which tracks the S&P 500 but trades differently, offered a potentially cleaner structure to analyze. He really focused on the 598 level in SPY. This level incorporates some previous highs that might now act as support and also recent lows that formed around it.
So 598 is the key pivot for SPY.
That's how he framed it. He described 598 as the crucial level for bulls. They absolutely must hold price above it. A failure, a break and hold below 598, would suggest a bearish flip in the short-term structure, potentially targeting the 595.50 channel low. On the upside for SPY, supply sits around 601, with targets above that at 603 and potentially pushing towards 6050 on ES futures if price can clear that 6025 high or even just hold firmly above 6,000.
What about the smaller cap stocks? Did the Russell 2000 IWM show anything different?
Yes, the IWM provided a bit of a contrast. He noted a nice breakout over the 210 level on Friday. He described that move as a very clean, bullish setup on the chart. He sees potential upside targets for IWM at 216 and maybe even the 200-day moving average further up. So relative strength in small caps compared to the chop in the large cap indices.
Okay, so we have this choppy, tricky intraday action, especially in the major indices. But what's the technical read on the broader, longer-term macro trend according to the charts?
He was very clear on this. He reiterated that despite the current intraday trickiness and chop, the daily chart macro trend remains without a doubt a bullish uptrend. He characterized this trend as price generally grinding higher, often finding support and bouncing off the daily 20 SMA. This suggests that, on a bigger time frame, pullbacks to that moving average have consistently been bought.
He also mentioned a specific divergence on Friday that kind of exemplified why the market has felt so tricky lately.
Yes, exactly. He specifically noted that on Friday, the NASDAQ Q futures, NQ, made a lower high on an intraday basis, while at the same time, the S&P 500 futures, ES, made a higher high. This kind of divergence, where the two major indices are not moving in sync and confirming each other's direction, doesn't happen all the time. When it does, it's often a sign that the market is in a trappy, unpredictable phase, where traders need to be extra precise and really pay attention to these subtle differences in what different parts of the market are doing.
That makes sense. It explains that feeling of being whipsawed. Let's quickly remind folks again, drop a like and share if you find this level of detailed analysis valuable. Okay, let's zoom in further now and look at a few specific stock setups and key levels from Deciano's technical analysis.
All right, sounds good. Picking out just a few examples that illustrate different kinds of technical situations he highlighted. For Tesla, TSLA, he noted the price had broken back below the 295 level. He expressed caution here because the stock is trading below resistance from both the 100-day and 200-day simple moving averages, which are overhead.
So 295 is the line in the sand for Tesla.
That's the key level he identified. The play is to watch 295 closely, either for a decisive reclaim above it, and then it would need to clear 312 and those moving averages to really signal upside potential, or for a rejection at 295, which would technically target the 270 channel low if price stays below that 290-295 area. He specifically noted Tesla is often full of tricks, so caution is warranted.
Okay, what about a stock that looked stronger technically?
NVIDIA, NVDA, was a prime example of strength. He described its chart as having an insanely nice structure and a clean bullish structure. It's been consolidating at higher levels, effectively turning previous resistance highs around the 136, 137 area into new support lows.
So building a base at highs.
Exactly. He sees it looking ready for the next leg higher. The level to watch there is 144 a break, and hold above 144 could signal a push towards the 150 level, which he referred to as channel 3 in its potential upward trajectory.
Any examples of pullback opportunities he flagged?
Yes, Broadcom AVGO was one. He viewed the pullback after its recent earnings report positively, suggesting it might be a healthy consolidation. He specifically identified the zone around the daily 20 SMA, roughly 238-240, as a potentially great area to watch for a pullback long entry, should price dip back to test that support.
What about Google, GOGL?
He called Google a potential comeback candidate. He's watching for a move over the 177 level for potential follow-through towards 180 and then 184. He noted it's currently holding support around 174, but he also highlighted a deeper pullback level as a potential rockstar entry for longs, the 172.50 area. That level lines up with the daily 100 and 200 SMAs and also fills a previous gap on the chart, making it a confluence of potential support.
And maybe one more. How about Coinbase? COAM,
Yeah.
given the Bitcoin discussion earlier.
Right, Coinbase. He noted a big hold at the 240 level. Yet again, that level has been key support. Price was back over 253 at the time of analysis, but he cautioned it was trading up into a heavy area of potential resistance. The trading idea he mentioned was potentially longing that 240 hold, looking for a possible short squeeze that could push the price up towards the 280 level, while being very aware of the significant resistance overhead.
Okay, that gives us a really good sense of how this purely technical approach works, identifying specific price levels, structures, support, resistance, and potential trade setups based solely on what the chart is showing for individual stocks and indices. What's the main actionable takeaway from this technical segment, especially considering the tricky, choppy market environment Desiano described?
I think the key actionable takeaway is really about using these specific identified levels and chart observations to develop your own trading plan. And especially in this current market environment that he explicitly called trappy, and which is showing clear discrepancies between indices like NASDAQ and S&P, patience becomes absolutely crucial. You need to wait for price action to clearly confirm a direction relative to these key levels before committing capital. That principle, trade what you see on the chart, not what you hope or think or read elsewhere, becomes paramount when the market is behaving unpredictably. Avoid assumptions.
Excellent point. Patience and confirmation seem key right now. Okay, so pulling everything together from this really comprehensive deep dive into all these sources, we've definitely highlighted some major areas of tension, disagreement, and uncertainty swirling around the current market landscape.
We really have. We started with that focused look at Bitcoin data, right? Seeing how specific liquidation zones on the heat map could potentially act as price magnets or volatility triggers, while the fundamental network metrics from the dashboard paint a picture of a fundamentally healthy, secure, and scarce digital asset, regardless of price swings.
Right. Then we zoomed way out to the macro view with Darius Dale. His systematic, data-driven process is signaling Goldilocks a generally positive regime. But crucially, he points to this pervasive, maybe even overdone level of investor anxiety, largely fueled by things like tariff talk. And he expects this anxiety will eventually crack, leading to a wave of FOMO buying, his actionable insight, positioned before that wave hits.
And then we spent a good chunk of time in our Market Spotlight section exploring how different experts analyze the exact same economic environment and arrive at sometimes starkly different conclusions. We saw data suggesting consumers might be proactively borrowing now, specifically due to fears of future tariffs.
Yeah, the auto loan surge.
Exactly. And then the jobs data, how under rigorous statistical scrutiny, it appears much weaker or stagnant than the headline suggested, a view backed up by rising layoff announcements, even though the market itself rallied hard on that potentially misleading headline number.
We also explored that whole debate around inflation and tariffs. Will tariffs lead to a slow, gradual, multi-year drip of price increases or a more immediate surge pushing inflation higher by year end? And how that disagreement feeds directly into the conflicting views on whether the Fed has permission to cut rates now based on recent benign inflation data, or if they need to hold steady fearing future inflation or even asset bubbles.
And let's not forget AI, the potential disruptive impact And the highly uncertain timing of artificial intelligence on jobs and the economy emerged as another major point of significant expert disagreement.
That led to that stark practical advice about maybe needing a today plan in the face of such rapid, unpredictable technological change.
And finally, we wrapped up with the technical picture from Vincent Deciano. His analysis confirmed the market is currently tricky, choppy, showing divergences between indices demanding real precision from traders. But it also identified those specific key price levels and potential stock setups that technical traders are watching closely, reinforcing that principle of trading what the chart actually shows you, not just your opinion. It really underscores that becoming truly well-informed in this kind of complex, noisy environment requires going way beyond just the headlines. You have to question the data, understand the methodologies, consider these diverse expert perspectives, macro, fundamental, technical, and really try to identify the specific data points, the contradictions, and the price levels that genuinely matter right now. The surprising disagreements and ambiguities we've highlighted today really demonstrate the absolute necessity of taking this kind of multifaceted approach.
Couldn't agree more. So let's leave our listeners with a final thought to chew on, something that builds on everything we've covered today. Here it is. Given the deep statistical ambiguity we've seen in key economic data, like the jobs report, coupled with this widespread expert disagreement on the likely path of inflation and appropriate Fed policy, can we still rely on these traditional data prints as reliable signals for market direction? Or does this kind of environment demand entirely new approaches, maybe new data sources or frameworks, for truly understanding economic reality and navigating market movements going forward?
That's definitely something worth mulling over as you digest all this information this week. A challenging question for uncertain times.
Markets move fast. Pinpoint your next profit window and seize the moment.